Good morning. Welcome to Market Monday for March 3rd, 2025. Well, didn't take much, did it? Just a week or two ago, the S&P 500 had its highest weekly close ever. And now that it's a little more than just 2% down from the highest it's ever been, sentiment is in the dumps. Just how bad is it? Consumers haven't been this pessimistic about their household finances for the next 5 years since December 2013. Here's a small reduction during COVID. Here's 2022. Essentially no news to report here. But here in 2025, with the market hitting all-time highs, expected change in financial situation 5 years ahead is utterly cratering. Here's another look. The AAII, American Association of Individual Investors, percentage of bears above 60%. This line right here. Touched it in 2022 with stock markets off from 25 to 35%, bonds down double digits, fastest hiking cycle in the past 50 years, highest inflation since the 1970s. COVID, market down 10 and 12% in one day? Nah. Have to go back to the global financial crisis to see these levels. Remember a few weeks ago, Chad was talking about this level moving so quickly in the span of 2 weeks? Have a listen.
Bears being up 13% in 2 weeks. See that right there? Is also very rare.
And now, almost 50% in 2 weeks? Here's the S&P 500 stock market with these rare times the AAII bears have crossed 60%, typically after the market had already declined. Of course, here's global financial crisis, here's 2022. We can see down here, historically speaking, the returns 6 months and 1 year later have been strong. Here's another look. You see here, AAII respondents can also be neutral, and it's usually about a quarter of respondents, so a meaningful amount. The last 2 charts we looked at were just bears over 60%. What about when bulls minus bears is negative 40% like we have now? Of course, there's a chart for that. Just 11 times over the past 35 years, and about half of those were in 1990. So in the 21st century, just once, 5 days before the market bottomed during the global financial crisis, quite a few times in 2022, then now, with the market off just more than 2% off the all-time highs. 3, 6, 9, 12 months later, a lot of green on the screen. And one more for good measure, the CNN Fear and Greed Index, for what it's worth, is showing extreme fear as well. All right, so what gives? Could it be this? The Buffett cash pile. Warren Buffett's Berkshire Hathaway cash pile swells to a new record, $334 billion. Or this, home builders' unsold inventory, highest level since 2009. Or this, the market, as we've been talking about, is fairly expensive, historically speaking, at least certainly not cheap. Or this, housing starts, literally how many houses are starting to be built. A lot of jobs and economic activity follow housing. Going back to 1970, it appears when housing starts roll over, a recession typically follows. And yep, we've got a rollover. Or is it this? DOGE, the Department of Government Efficiency, headed up by Elon Musk, seeming to cut tens or hundreds of billions of federal government spending. We are not assigning morality to this. We leave that to you. However, it certainly is a disruption to the status quo, which causes uncertainty. And as we know, the market hates uncertainty. So where does that leave us now? Here's a composite looking at every 1 year, every 4 years, and every 10 years, combined together since 1928. Here's where we are right now. And here's every post-election year since 1900. Just history, folks, no guarantees. With all this sentiment, how we feel about things, one piece of hard data we're looking at is credit spreads, or how much more do risky bonds have to pay than high quality bonds. In times of stress, risky bonds have to pay a lot more because the risk of default is so much higher. So here in the global financial crisis, .com, COVID right here, as far as credit spreads are concerned, all quiet on the Western Front. And today, we'll leave you with